I'm sorry, I lost you. Do I think that what is not?
That risk and return are not correlated?
I don't. That's a good question. Beforehand, if you asked me maybe a year ago, right, I think I would say, absolutely I'm on portfolio theory, but just kind of given my own experiences kind of in the fund and in the certain places where we have outperformed, I think that there definitely is more to the argument than modern portfolio theorists let on. I don't think they can be perfectly correlated now because of a lot of these reasons that Klarman put out and a lot of this other literature I've been reading, in that it's just people are people. They just. Sorry, go ahead.
Yeah, no. I think you're right. I agree with you. But I think you could maybe argue or look into, maybe it could possibly be inversely correlated from what you think. I think a value investor would tell you there is a correlation. It's just the opposite one you were taught.
Oh.
So it's the less return you take, the higher your the less risk you take, the higher your return. The higher your return. So there is a correlation.
Right.
It's just
the data certainly seems to show that later on, which is very, very interesting.
It's an inverse correlation. So a true value investor will seem to think the less risk you take, the higher your return.
Right.
It's like if you buy a stock for $1 instead of $4, your return will be much higher. And your risk is less because you're only buying it for $1 versus $4. Your risk of loss is much less too.
I definitely see that concept in like averaging down, right? That kind of thing.
Yeah. So if you think about, unless it goes bankrupt, of course, less risk, more return, right?
Right.
But if you know what you're doing and you know it's not going to go bankrupt, it's an inverse correlation. Anyways, continue. Sorry, just something to think about. Just throwing that out there.
Yeah.
I think they do believe there is a correlation. It's just an inverse one.
Okay. All of these would actually make very good thesis topics. Just
throw your textbooks in the garbage.
Right.
Just kidding.
Yeah, they're expensive. Don't throw them in the garbage.
All right. Let's go on here. So these are just the 8 super investors that I picked. I know they were supposed to be random, completely random, but I did want to pick ones that were more recent, that had a more recent time horizon. So investors that had fund history, at least dating back to 92, 90s, etc., just such that I could construct this index. And so these are just the qualifications, which I'm sure all of you are familiar with, but each follow this Graham-Doddsville style investing, etc. But the one thing that actually intrigued me about all of these investors is even in the presentation you sent me with kind of a breakdown for all these different investors. When I looked at their their portfolios and their holdings, right, it's interesting because these are all value investors, right? These are all value investors under Graham and Doddsville, right? But interestingly, their methodology still differed within that kind of umbrella, right? Because we have people like Prem Watson, Mario Gabelli, all have pretty reasonably diverse portfolies, right? It's not all financials, it's not all telecom, etc. But there's value investors like Bruce Berkowitz, right, who just straight up say, why would I invest more money in my 60th best idea when I can invest more in my first best idea, right? And he's just 90%, 90% straight up financials. And I thought, wow, that seems incredibly risky, but also incredibly daring at the same time, and it's such a wide variety, I guess, among them, but it's still value investing, right? They're still conducting that fundamental analysis, but their approaches toward diversification are different, which I just thought was interesting.
All right, hey, this is Caleb.
Yes.
The analyst here. I'm glad you brought that up because I threw in Mario Gabelli in there, sort of value investor, but you're the first one to actually catch that as just a different type of value investing and a little bit riskier. So, I'm just saying thanks for bringing that up.
Yeah.
I'm first to do that.
Yeah, these are all very, very interesting people. I actually wasn't familiar with a lot of, like, gurufocus. I just wasn't familiar with those sites before at all, but it was really cool just to read up on, how they got to where they were. But yeah, so here we have one of our first, kind of data slides, but these are just annual returns, and what kind of stuck out to me was, we look at the super investor index, and you look at the other, the performance of the indexes, right, and it's actually not super impressive, right? They're not killing it every single year. It's not that they're outperforming all the time. They're not beating the market all the time. But the secret here I see, and this is just reinforced later on, is that when the market goes down, they never lose as much money. So they don't tend to spike up super much all the time. They don't tend to beat everyone all the time, but they never lose a lot. And the power of compounding later on, when we see cumulative returns, it just really, really begins to pay off. The market indexes themselves, they're just much more volatile as a whole, and they just go up and down. But the problem is, you always lose more when you go down, because then you have to work twice as hard to go back up, right? So that was just the main takeaway here for me. As you can see, just they have, Super Investor Index has the least volatility, but performance-wise, they just don't lose as much in the downturns. Average returns here, going on, Super Investor Index still has highest averages and at the same time lowest volatility, which is frighteningly amazing, I would think. But I also thought it was interesting that as the averages went up, like 10-year, 15-year, 20-year, the difference in performance, the average returns really seem to get higher and higher for me. So it just really shows that long-term get rich slowly kind of mentality really at work. All right, so here's the efficient frontier I constructed for S&P 500 in bonds, right? So this is just tracing through the different percentages, 100% in the S&P 500, and then later on 100% in bonds. And so this here would basically be an anomaly, right? Because we're going above and beyond the Sharpe index with these super investor returns, which are indicated by this green triangle here. But what I thought was kind of interesting here is this is a MPT here, and this is kind of something that I really got much deeper and delved more into last semester, right? And my professor was actually a very, very big proponent of this, to kind of see something like this, right? With just these 8 super investors, and these are just 8 people, right? Which was kind of destroying the efficient frontier in this sense, was very, very amazing. Do you guys have any questions about this slide or anything of that nature?
Yeah, can you explain what's your AGG? What does that include?
Oh, AGG is basically a bond. So that's just the Barclays kind of aggregate, just representative bond fund. But I didn't catch the first part. What did you ask before that?
No, that was kind of my main question. And you calculated your Sharpe ratios?
Yes. So overall, I mean, if the equation itself would just be, the return of the asset minus the risk-free rate over the standard deviation. But overall, it just, I guess I have an appendix slide sort of talking a little more about this. But basically what I did is I just calculated these summary statistics, right, for the S&P 500, the bonds. And then I just created a covariance matrix from that so that I could calculate, the standard deviation of the portfolio and then the optimal Sharpe ratio, which I then used to create the capital allocation line.
I'm trying to analyze Sharpe ratio where you have 0.48 and you have it's between the 0.74 and the 0.78.
Oh yeah, certainly. So the italics, right?
How did that drop off occur to 0.48?
How does the drop off? What do you mean?
Well, you have a point.
Oh, sorry, I can't hear you very well.
You have a 0.48 Sharpe ratio in between a 0.74 and a 0.78.
Right. Are you looking at the old version of the slides, actually? I actually caught that today. So this is, if you're looking at my desktop here, I actually corrected that. So when I copied it over from Excel, it actually, the formula was wrong, I think. So then I just changed that today.
What is it now? I can't see.
Oh, it's 0.45, 0.48, then 0.41. But yeah, I noticed that immediately today. I'm terribly sorry for sending you the wrong information yesterday.
No, that's okay. That's okay. I must have had a printout from earlier, so I was just looking.
Right. I was using Excel Solver, so I think I just messed something up there. And anyway, I just redid it today.
Okay. What'd you use for your risk-free rate, the 4.59%? Was that
sure? What I ended up doing for that is I just took I just went. And I wasn't necessarily sure whether I should use the 20-year Treasury, but the only issue was I couldn't find the data to match the time horizon. So I ended up using the 10-year Treasury, but then I took an average over 20 years, just representative of the 93 to 2012 time frame.
Okay, yeah, I was going to say, because the 10-year Treasury right now is at, just under 2%.
Right.
So you just took an average of all those?
Right.
Okay. All right, cool.
Would it, just out of curiosity, in this case, and I'm kind of new to this, so I just learned kind of the matrix multiplication and this stuff this semester. But would it have been more accurate to use the latest 10-year Treasury? But I thought taking an average would have been more suitable for the time horizon.
Yeah, I think you probably did the right thing. I mean, interest rates have been so low the last quite a few years. It probably skews average numbers to the low side. So I don't think it's that bad. I mean,
I actually did try it with the latest Treasury rate, but then the result was crazy. Like the Sharpe ratio was upward at like 0.8 or something. I just thought